Hello and welcome to Inheritance and Tax Planning, what lies ahead for the autumn 2024 budget. Not the snappiest of titles, I will try harder next time. My name is Richard Dundee, I'm a partner at White House Solicitors in Leamington, and my speciality is private client, which effectively means estate planning, drafting wills, dealing with the weird and wonderful tax inquiries that individuals, farmers and businesses have. The purpose of this podcast is to talk about the upcoming autumn budget, that being at the end of October. There's a lot of scepticism, a lot of concern about what a new Labour government might look to do in the budget, whether or not they are going to reduce allowances for various taxes, introduce new taxes, remove exemptions, or effectively rewrite the rule book. What this has done has caused an element of concern amongst the various clients that we deal with at Right Hassle. What we thought it would be useful would be to consider what the position is now, and then in a subsequent podcast, after the budget's been released, consider what changes have been made and what we can do in light of those changes to help our clients deal with the potential problems or benefits that budget has brought about. As an introduction, I thought it would be useful just to go back through the importance of inheritance and tax planning. Death is going to happen to all of us. The famous saying, and I keep forgetting who said it, but the two things that we can guarantee in this life is death and taxes. My job, my goal as a private client lawyer is to guide my clients through what they might face, or what more importantly their family might face when the inevitable happens. Tax isn't inevitable. A lot of people talk about how inheritance tax is a voluntary tax, and by that we don't mean that you can choose to pay it if you need to, but more that if you plan well enough in advance, it may be that you don't need to pay inheritance tax. And some of the things that we're going to talk about today, the exemptions, the reliefs, the gifting allowances that are applicable for an individual, farmer, businessman, whoever it may be, it requires for those individuals to know that those allowances and reliefs exist. So I'm hoping one of the outcomes of this podcast will be that you know a little bit more about the things that you might need to go and investigate to ensure that you or your client's estate planning is correct and is doing what it should be doing for them. So I wanted to have a brief conversation initially about why inheritance tax, capital gains tax, and various reliefs matter. I believe this is an important subject, personally, because death will happen to all of us. And a lot of people believe that inheritance tax is deeply unfair. Nobody likes the idea of paying tax all through their life, be that income tax, VAT, capital gains tax, whatever it might be, on all the products that they purchase and the services that are provided to them, only then for the government to turn around and take an additional 40% on death. It's therefore important for clients to understand that there are ways to mitigate inheritance tax, be that by using their annual allowances for gifting, or considering different types of investment or products that could mitigate their exposure to inheritance tax and ultimately ensure that their family receive more when they pass away. It's important for us to consider where the current position is. A lot of us will know that inheritance tax is applied at a rate of 40%, 36% if you should leave more than 10% of your estate to charity. And that's quite important to know because a lot of people don't know it, simply put. It was well publicised many, many years ago, but it always baffles me that clients aren't aware of that and how pleasantly surprised clients are when you tell them, well, actually, the gifting that you're looking to make to charities will qualify you for this additional or this reduced rate of inheritance tax. I honestly believe that more people would consider charitable gifting, especially those with very large estates, if they were aware that there could be a reduction in inheritance tax due to that 4% reduction in rate. We also must consider that a lot of people will not pay inheritance tax as their estates fall below the initial threshold of £325,000. Now that allowance, that nil rate band, as the government calls it, can be doubled if you were to leave all of your assets to your spouse on first death, and then tax applies on the second. Now, they introduced a residence nil rate band in 2015, which was deeply controversial for lots of reasons, and I'll briefly touch on that in a bit. And there's some suggestion that that might be scrapped. I don't believe they will, because it was made, in my opinion, very cleverly to ensure that tax receipts continue to rise, but equally the optics of it are very good. Business property relief and agricultural property relief were reliefs introduced in 1984, so a significant time has since passed before they were introduced. And the purpose of them is to ensure that business owners and farmers alike can pass on their assets to their loved ones, to their chosen beneficiaries, without the fear of having to sell those businesses to pay a significant amount of inheritance tax on death. Now, there were good reasons why that was introduced, good economic reasons, predominantly being that if you're a business owner, or if you're the government, shall I say, you don't want the business owner and their executors to sell the business on death, because that will mean that VAT and income tax receipts decrease, because you may have to lay off the entire workforce. The same for farmers. The government should not want, and I hope do not want, but we'll see when the budget comes out, we do not want farmers to start disposing of their land for development purposes, simply because they have to pay a significant inheritance tax liability when they die. We want those farmers to pass on their land to be farmed in the next generation, and again and again and again. And that was the idea of business property relief and agricultural property relief. The other thing that we're going to consider today is capital gains tax. So this being the tax on gains made when assets are sold. And a lot of you may know, but it's important to remember that on death, any gain that an asset might have will be wiped out. I say wiped out, what happens is the value is rebased at the date of death value, so probate value. But what that means is that if an asset is pregnant with gain, we might say, so you buy a house for 100 grand in 1990 and you sell it for £1 million when you die, you're not going to have to pay inheritance tax and capital gains tax. The government has a long-standing tradition of not taxing people on death twice. I'm hopeful, but it's for us to see whether or not that policy of double taxation is going to change, and we'll touch upon that in a moment. So the key questions for the podcast is, what changes are likely in the 2024 budget regarding the various taxes and reliefs that we spoke about, and how should individuals, business owners and farmers prepare for those potential reforms? So before we answer those questions, let's dive deep into the current landscape of the inheritance and tax planning. So we've already touched upon how the inheritance tax system works. So we've got the nil rate band, that's per individual £325,000, and we have this slightly controversial residence nil rate band. Now, the residence nil rate band is an allowance you receive, or your executors can benefit from, or claim, I should say, if you pass away with a property and you leave that property to what we would call linear descendants. Now, that in practice is children or grandchildren, but there are lots of other categories that might fulfill those tick boxes. The problem with the residence nil rate band is I might not own a house. I might rent a house. A lot of people in Birmingham and London do not own their properties that they live in. Equally, I might not have children, but I own a property. So it is arguably quite discriminatory. But either way, the rules are in place, and that means that if you can tick the various boxes, you will have not only your nil rate band, you will have your residence nil rate band. And for a married couple, that could mean that you have allowances worth £1 million. So 2 lots of nil rate band at £325,000 per person, and 2 lots of residence nil rate band at £175,000 per person. I would say nice and straightforward, but in principle, for all the reasons we've just discussed, it can be tricky to get that £1 million in total. There are, of course, other reasons why you might not get the full amount. It might be the residence nil rate band is reduced because the value of the property you have doesn't quite sort of cover off the £175,000 allowance. You only get up to the value of your house. The nil rate band can be reduced by any gifts that you've made in the last 7 years. This can eat into that allowance. So there are lots of trips and traps that might mean that that magical £1 million allowance you're hoping for, or your clients are hoping for, does not quite come to fruition. We can see an awful lot of disappointed people come to us because they're not fully aware of what the landscape is and what rules and regulations they have to satisfy. The other thing to note here is that the inheritance tax threshold, this nil rate band, it's been frozen since 2009. House prices have risen dramatically since 2009. I sold my house recently, and I was surprised at how much it had increased in 5 years, let alone the last nearly 15. This has led to that wonderful term fiscal drag. So tax allowances being fixed, but asset prices increasing. It's a really easy way for the government to make more money without doing anything. It's quite controversial, and what it's meant is that more estates, more families, more farmers, more businesses are pulled into the tax net as asset prices rise in value. Capital gains tax. We've already touched upon the fact that capital gains tax interacts with inheritance and with estate planning. We spoke about very briefly a moment ago this death uplift, the idea that when beneficiaries inherit assets, they inherit it at the value at the date of death, and any gains that had previously been made by the owner, the testator, the person that's passed away, are wiped out. There's some suggestion that that might change, and we'll come on to that in a moment. Business property relief, agricultural property relief. These are reliefs that apply to business assets and farmland. Now, over the course of the last 40 years since these rules were applied, business property relief in particular has changed, or more particularly, the assets that it would apply to have changed. And what I mean by this is that there are now opportunities within certain investments, certain schemes, where you will get business property relief if you invest with certain companies. Now, the question is whether or not that was within the spirit of the original intention of the government back in 1984. And what I fear we'll see, and I'll come on to when we talk about the potential changes, I foresee the Labour government using that argument that I've just mentioned, the idea that this was never the original intention, to effectively considerably restrict business property relief on certain investment schemes. Now that would be incredibly disappointing for financial planners, accountants, and estate planners such as myself, because it's been a really useful tool for clients with significant cash assets that are going to suffer 40% tax when they pass away. Business property relief, currently clients can obtain either 100% relief if this trading company that they have or the relevant investments within these schemes are held for the qualifying period, normally 2 years, and they satisfy the requirements of the 1984 legislation, or you can obtain 50% relief. Now, you obtain 50% relief if you own an asset that a business is operating from. Now, there are more convoluted rules than that, and we don't have the time today to talk about them in great detail. But the point is, you can obtain business property relief even if you are not necessarily running that business. And the idea behind business property relief, as we mentioned before, is to allow for family-owned businesses transition across generations without the fear of a heavy tax burden, without the fear that their company is going to have to be sold in order to satisfy a significant tax liability. The same can be said for agricultural property relief. It's a relief, as the name suggests, that applies to agricultural property and land. It allows farmers to pass on that farming businesses largely free from IHT, from inheritance tax. It allows farmers to know that they can pass on their asset, their livelihood, their legacy without the fear that inheritance tax will take a large chunk of it, meaning that the farm is no longer a viable business. So the worries that we face are twofold, really. That there is a steady rise in property values, frozen tax thresholds since 2009, meaning that more inheritance tax is biting. More families are being dragged into this tax burden, and this has mean now middle class families, whatever that term means, are now experiencing a tax that they had never anticipated would apply to them. There are complexities and uncertainties surrounding reliefs like business property relief and APR, which creates challenges for business owners and families. But the rules have been around for so long that advisors such as myself are able to advise our clients on what they may need to do in order to satisfy those rules. The worry is that if these rules change dramatically, which they potentially might, this will cause significant stress and uncertainty for clients. There may be snap decisions made by farmers and business owners that will only negatively affect the economy in the long term. So what's going to happen? And that's the real purpose of this podcast. What are my predictions for the autumn 2024 budget? What do I expect to see? And really, this boils down to the pressures that the Chancellor is likely to be facing. We've all heard of the $20 billion black hole that has been announced on every news outlet, every newspaper, every LinkedIn post over the last couple of months. The Chancellor's feeling significant pressure to raise revenues due to inflation, public sector borrowing. There is a need, it would seem, to balance public finances. And as we discussed before, inheritance tax reform could play a significant role in this. The tax's growing yield has attracted political attention. And because there is a notion that inheritance tax only affects the wealthier part of society, it wouldn't be necessarily political suicide for inheritance tax to be a major target for additional revenue. There has also been, over the last couple of months, an awful lot of government promises on tax simplification. And this idea of tax simplification and relief may clash with the actual fiscal reality that the Chancellor has in front of her. Now, this is going to lead to complicated trade-offs, and one of the trade-offs is the inheritance tax burden and capital gains tax burden will have to increase to cover off the complicated public sector issues that the Chancellor is facing. Now, what does that actually mean? What do I predict is going to happen? Well, one of the things that could happen here is they will raise or adjust the nil rate band. So this being the £325,000 allowance we all have, or this residence nil rate band that is added on top in certain circumstances. There has been speculation that the government may reduce the inheritance tax threshold, currently £325,000, or introduce an additional band for higher value estates, reflecting the property price inflation, so charging more inheritance tax for those that have more assets. Another possibility might be to index the thresholds to inflation. This could reduce the inheritance tax burden for middle-income families over time, but increase the inheritance tax burden for those with larger estates. It's very similar to what the government was suggesting they would do with the probate court fee many, many years ago, when there was uproar about the idea that people with larger estates would pay a larger court fee. And if you remember, there was speculation that the court fee for estates over a certain threshold would be in the region of £10,000 to £20,000. It was an additional tax more than anything. Now that, of course, after an awful lot of conversation amongst the profession, was scrapped. But it wouldn't be too difficult for the government to do something similar. It is likely that the government will tighten the eligibility criteria for business property relief and focus on active businesses. This would strip away the business property relief available to those investing in the types of schemes that I mentioned earlier. So enterprise investment schemes, alternative investment market portfolios, those types of investments that will qualify for 100% relief after a period could lose that potential relief. Now, what effect will that have? Well, as I suggested earlier, those clients that have a large amount of cash that's likely to be subject to inheritance tax on death will have even fewer options as to what they can do with those assets to mitigate their exposure to inheritance tax on death. There's also been a suggestion that they will cap the value of business property relief qualifying assets. There's been lots of material floating around LinkedIn and various different websites suggesting a £500,000 cap on business property relievable assets. Anything over and above this amount would be taxed at the standard rate of 40%. They could also consider the reduction in the relief from 100% to 50% for larger businesses. This would be a less drastic measure. They're not completely stripping away relief, which may therefore mean that the larger businesses can continue trading even after one of the main business shareholders or directors pass away. It may, however, still have significant impact on the smaller family-owned businesses that will then need to find a significant chunk of assets if liquidity, other cash and investments are not present. If the only asset is the business, it doesn't matter if the relief has been stripped down to 70%, 80%, they're still going to have to find some money to pay the tax. In respect of agricultural property relief, once again, there's been a suggestion of introducing caps, probably on a similar level to business property relief, that £500,000, and once again reduce the actual relief available, potentially from 100% to 50%. One of the most drastic changes they could make to agricultural property relief is introduce this idea of active farming. So an extra criteria for farmers to satisfy on death was the farm being actively farmed. Now, I take this to mean that only land that is actively farmed could qualify relief, leaving more inherited agricultural lands subject to inheritance tax. So if Mrs. Smith has inherited 40 acres, then she may not receive agricultural relief on her death. But if Mrs. Smith is actively farming that land, she's not just the owner, but she's the farmer, then she will receive that relief. Now, that might have a positive effect on society and the economy as a whole if it encourages people to produce. Chances are, however, it's likely to have the opposite effect. It will just mean that people sell up. The impact of this on small family-run farms could mean that they struggle under a more restrictive regime. And as I say before, is it likely that farmers are simply going to take that golden ticket when a developer knocks on their door? Finally, capital gains tax. What's likely to change there? Well, I've already hinted, and it's no surprise that the concern for estate planners, financial advisors alike, is that they might reduce or scrap the death uplift provision, meaning that I pass away, my estate pays inheritance tax on the assets over and above the available allowances, but then subsequently, if I've held my house for a long, long period of time and it's risen in value considerably, my executors may also pay capital gains tax at the applicable rate. This double whammy could bring in a significant amount of additional revenue for the government. Also, in relation to capital gains tax, has been a suggestion that they will try and introduce a flat rate for all asset classes. So at the moment, a personal representative, an executor, would be able to pay capital gains tax at 24% for residential property and 20% for other assets. There's a suggestion that they might flat rate this at, say, 28%, which once again will drag more assets into a larger tax liability, increasing revenue. It's a subtle tweak, but we could see a significant amount more tax being raised by the government. Finally, in relation to capital gains tax, and we've seen this over the last 5, 6, 7 years, the possible reduction in the annual exempt amount for capital gains tax. It's currently £6,000. It used to be significantly more, and it's already had a significant effect on families looking to pass on assets. Those assets pregnant with gain. Further reductions in this annual exempt amount will once again increase the additional revenue to fill that £20 million black hole. So what can we do? I suppose this is the end of the podcast, really. I've told you about what the current position is. I've suggested to you possible changes. What can we do? Well, the answer is not a lot. We've got to wait. I'm looking forward to getting my glass of whiskey and my bag of popcorn and sitting down for 2 hours on the 31st of October and watching the Chancellor give us her assessment on what needs to happen. That being said, I did that in the last budget, expecting a significant change to inheritance tax and capital gains tax, and nothing happened. So this could all be bluster. This could all be political grandstanding from the new Labour government singing a good song. We won't know until the Chancellor stands up and tells us what the new world looks like. But there are things that can be done now. The most important thing to do is review and update the estate plan that you've got. Understand fully what your estate looks like. What reliefs are you relying on now to mitigate your inheritance tax exposure when you pass away? Unless you know what your inheritance tax position is going to be, what your capital gains tax position is going to be, what the asset classes you have under your control, and what the potential tax liability might be if you died today, unless you know that, it's going to be very difficult for you to understand what the effect of the budget is. Consider using lifetime gifts and trusts to reduce the taxable estate before the potential new tax rules take effect. It's unlikely, in my opinion, that the Chancellor will introduce rules that will apply immediately. So there may be a grace period whereby certain planning can be utilised, taken advantage of, that might further mitigate your exposure to taxation and other threats when you pass away. Now is the time to sit down with a lawyer and consider your options. And we are seeing that happen quite a lot with our farming clients and our business owners. There are ways of taking advantage of current reliefs. We can use business property relief and agricultural relief for family farms and businesses now. We don't have to wait until we die, so we can lock in those reliefs if the correct planning is used. Furthermore, if we were intending to make gifts of assets with potential capital gains tax liabilities, now is the time. It's highly unlikely, based on the negative position that Labour's given of the economy, that they're likely to increase the annual allowance for capital gains tax. It's only going to get worse. Therefore, if you're looking to move assets into trust or to your children or otherwise, now would be the time to do it to reduce your exposure to that capital gains tax when you finally transfer those assets. It could be that you consider making strategic sales of assets to utilise the current tax bands and allowances. This is something I strongly recommend you speak with your financial advisor about. And finally, it would be revisiting your succession plans for businesses and farms, ensuring that transfers qualify under the existing rules. If they don't qualify under the existing rules, chances are they're not going to qualify under any new rules that apply. And even so, we want to make sure that you are going to obtain as much relief as physically possible, even if that relief is shrunk and tightened. Now's the time to consider what tax you're likely to have to pay when the time comes. And finally, consider the importance of planning the transition of assets. Do I have a will? Do I need to move assets now? Do I want to retain control of them? It is fair to say that no one knows the future. Only the Chancellor knows what she is going to do on the 31st of October. And the chances are those plans might change. Every day there seems to be a new scandal or a new conversation in the Labour government ranks. So who knows whether or not the current Chancellor will still be the current Chancellor on the 31st of October. Either way, it's important that you, your clients, your friends, your neighbours, whoever it may be, consider your current planning, consider the reliefs that might apply today, and be aware that things are more than likely going to be restricted and tightened. So if you are planning on making gifts, if you're looking to transfer assets in your lifetime, or you're worried about what tax might apply when you die, now's the time to sit down with a specialist lawyer, such as those at Wright Household Solicitors, or have a conversation with your financial advisor and consider the planning that you've got in place. Next time on the podcast, we're going to consider, as I said at the beginning, what the autumn 2024 budget brought. I'm hopeful that nothing will change, or if it does change, it's only got better. I'm an optimist, not a pessimist. You'll learn to know this. What I would like to do, of course, is be very, very happy on the 1st of November. And it may be that there's very little to talk about. And if that's the case, it will be a short, sweet follow-up. And what we will do is spend our time addressing you listener questions. So if you do have a question about business property relief, agricultural property relief, capital gains tax, inheritance tax as a whole, strategies for mitigating taxes, please do feel free to email me at richard.dundee@wrighthassel.co.uk. That's richard.dundee@wrighthassel.co.uk. And hopefully we can spend some time on the next podcast going through those questions and answering absolutely everything and anything that you might want an answer to. I hope you found this useful. I've enjoyed speaking to you for the last 30 minutes, and I look forward to receiving your questions for the next podcast.